Yield, and they settled on this company. But this Dynamic Yield company will still operate as an independent company. But according to McDonald's, the reason why they invested in this company was not just for what they do, but more of the people and the engineers that are at this specific company. They felt that it was a really good match for them. So in terms of other competitors coming in and using specific Dynamic Yield, that probably will not happen because it will fully be acquired by McDonald's. But there are a lot of companies like Dynamic Yield out there that are collecting data and customizing menus and shopping experiences for a lot of these consumer companies.
All right, Heidi, great to see you. Thank you. Also watching MasterCard today, the company partnering with Apple and Goldman Sachs to launch its digital-first card. Joining us now, MasterCard U.S. Merchants and Acceptance Executive Vice President Linda Kirkpatrick. Linda, great to have you here with us today. Such a huge reveal yesterday. Wall Street was waiting for this and eager to see what some of the services would be. One of them is this card that will be through Apple Pay. They're partnering with you. But the analyst pushback on this was the market is saturated with cards like this. What makes this one different?
Yeah, well, this card is really unique in that it's digital first. So we're calling it a digital first co-brand. In the traditional sense, a consumer might apply for a co-brand at their financial institution and receive a physical plastic in the mail 8 to 10 days after they apply. In this use case, a consumer can actually apply for the card within their mobile app on their phone, and they would receive a digital version of the card first and can start using it immediately. So it really has some very unique characteristics, including the loyalty and the benefits that it provides in terms of cash back to the consumer, as well as the actual physical presence of the card. If the consumer does choose or opt to get a physical card, it's actually titanium metal. So there are lots of unique attributes of the program. The actual card itself excludes a number, a CVC, and an expiry date, as well as the consumer's name. So it simply has the brand mark of a
footprint on me. Now, I know MasterCard is entering the digital space on its own. Why choose to partner with Apple on an initiative like this now? Why not do a standalone product?
Yeah, so we are actually powering this product with safety and security that's incredibly secure. So we provide what's called tokenization technology that sits behind the product. And that essentially takes the card number and transforms it into a dynamic token each and every time that it's used.
Oh, like a secure ID.
Exactly. Right. So it really renders it useless to a fraudster who attempts to steal the credentials and leverage them on another site. So it's really embedded with the safest and most secure technology in the market.
And one of the things that Apple touted yesterday was the fact that you mentioned this was a cashback card, but also that it would be have a lower interest rate than other cards as well to make it more attractive. So how are the finances going to look?
So that's something that Goldman Sachs, as the issuing financial institution, would agree upon with Apple. As the network, what we are doing is providing the tokenization, the payments technology, the mechanism for the transaction to take place. And we're really excited about it. We think it'll have great appeal to a broad audience. Obviously, the iconic brand that Apple represents, as well as Goldman represents, coupled with the MasterCard brand, is pretty unique. We also think that it'll very much catalyze the contactless payments ecosystem. So in many instances, merchants are enabling their point of sale to accept contactless payments. And that's really any card that has this wave symbol and any terminal that has that symbol, you can simply tap your card on the terminal rather than having to swipe or insert it. So we're seeing the preponderance of these digital type programs, as well as these contactlessly enabled programs, help to catalyze contactless acceptance, both in traditional commerce as well as in transit use cases. You might know that many cities throughout the United States and even the globe are enabling their points of sale for contactless. And so it's, even here in New York, we're seeing the New York MTA transform their point of sale to include contactless, and we've been working with them and their integrator to light that up. So.
Really interesting stuff. Great to see you. Thank you so much for coming and joining us in our new studio, by the way, that we just launched yesterday.
Thank you. It's
Great to have
beautiful.
you. Thank
Great
you.
to be here.
All right, sixth ticker today, the new home price data. The question, of course, is what's the latest here, and is this market about to turn? Because that seems to be what everyone's saying.
Yeah, so as you mentioned, it was the new data that's kind of new today. 4.3% was the annual change as reported for the month of January. That is the slowest since April 2015, but that's kind of dissonant with what we've seen in housing starts. Actually, the most recent data that we've seen was actually 8.7% increase in February. That's month over month. That is a pretty large number. So you have this question about whether or not the pipeline of homes is not matching up with the actual demand for homes, since the prices have not inflated nearly as much as we've seen the housing starts. But as you mentioned, we are looking at the XHB, that is the Spider S&P 500 Home Builder ETF. This covers the likes of Beazer Homes, D.R. Horton, KB Home, and these are all home builders that have seen pretty impressive earnings growth so far. And again, we're talking about this most recent quarter, during which actually these stocks grew by 24%. That is this XHB index since Christmas. Again, that was kind of a low point for almost all equities. But in that same time, the S&P 500 only went up by 19%. So you see a lot of these home builders doing really well. And when you look at the earnings reports for this quarter, it actually, you look at BZH, for example, they beat earnings per share pretty readily. NVR, they beat earnings per share, also beat on revenue. So these are all companies that are doing fairly well. But it does raise this question with the new Case-Shiller Price Index information about whether or not we are reaching an inflection point.
Yeah, and you can see there on the full screen, actually on a day where the Dow is trading higher, actually all the markets are, NASDAQ, S&P 500 as well.
Right.
The home builders were actually down. Is that just because of the new the data that came out on housing starts?
Yeah, and that's exactly why. The question here is whether or not these home builders are perhaps creating too much of an oversupply. Actually, when you look at the Beige Book, this is Federal Reserve data that basically takes an index of how housing markets, among other economic indicators, are doing. They said that residential construction activity was steady or slightly higher across most of the U.S., but that residential home sales were generally lower. So again, you think about the lag here, right? I mean, these companies have these plans to build these homes for years, but home prices is current now data. So you have this question about whether or not the pipeline is perhaps overshooting at the point of demand at the moment. Now, I do want to note that this doesn't necessarily mean that there is a housing bubble. Actually, earlier on Yahoo Finance, on our On the Move program, we had Dr. Shiller, who actually created the Shiller Home Price Index, and he was talking about how, yeah, this, the price
Store in Massachusetts. The store slated to open in the early fall. Yahoo Finance's Dan Roberts is back with me. Dan, it's so interesting to me because the whole thing was how brick and mortar is going to die. It's over. It's gone forever. Well, now all the e-commerce companies are starting this. Wayfair is experimenting with it. Amazon, the e-commerce giant, trying it out. And then you could even argue a company like Tesla as well, saying we're going to do online sales, but have these spot showrooms because consumers need to touch things. They need to feel them. They understand that.
Yeah, the brick and mortar death march has been greatly exaggerated. I love this story. I love this story because we've been talking for years about brands that are born as online only. And at first they say, who needs a store anymore? We can just sell online. And then it turns out having a store or two or three or four or 100 is actually pretty good. Warby Parker, Untuckit, the men's shirt brand, the Tie Bar, a necktie store, Casper mattresses. All of these companies that started as online only are now starting to open stores. It turns out they do want a brick and mortar footprint. And I love the story because it's the inverse of how it was originally, where we looked at companies like Walmart and they started as brick and mortar only, and then they were a little late to realize, oh, we need to have an e-commerce presence.
Right.
So it turns out both matter. You can't just be online only, or you can't just be brick and mortar. Wayfair, a really interesting company, went public in 2014. Stock is up 135% in the last 12 months. Not that much in 2019 so far, but it's a company that when it went public, some people said, well, how is this company going to be okay in the age of Amazon? Furniture, you can get it elsewhere. There's IKEA. Well, Wayfair has done pretty well. Sales way up in the last year. The CEO, Neeraj Shah, is a really interesting, smart guy, big Boston guy. I'm from Boston. I know the Natick Mall very well. For a little while, they rebranded it the Natick Collection. They have now gone back to calling it the Natick Mall, but the point is, very fancy, very upscale. So that's interesting as well, that is where Wayfair is going to go and open its first store. But also, you mentioned Amazon. Before finally saying we're opening our first store, Wayfair did pop-ups.
Yes.
All about the pop-ups now. You do experimentation. You try and figure out where might we do well, and does it even make sense for us to have a brick and mortar presence?
Pop-up is like a less commitment version of it. You can try it out.
Yeah, you dip a toe in. Really interesting. And then Amazon, as you say, so many different physical store concepts that Amazon has right now, and I think soon you'll start to see them prioritize some over others. There's 4-Star Store, kind of a hodgepodge. There's only one right now. It's in New York. We did a big Yahoo Finance report. We went and checked it out. Then there's Amazon Go. That's the cashierless. I think that's the one that's really going to grow the most. Of course, they have Whole Foods, but we've also recently heard Amazon wants to own its own. On that, a lot of people have shown that actually they will buy clothes online, and so I think furniture, same kind of thing. I'm with you. A couch, I want to sit on it. I want to see it. I want to touch it. Not everyone feels that way. I think some of these furniture websites have done a very good job with having interactive 3D views, and you can spin the couch around and really get an idea of what it's going to be like.
I don't buy it.
Yeah.
All right. Thanks for that, Dan. Meantime, I want to take a quick check of the markets and see where we stand at this point in the session. Right now, Dow, S&P, NASDAQ, all up across the board, 62 points on the Dow. So definitely off of our session lows here, as Scott Gamm pointed out before, partially because of Boeing, but also still seeing positive sentiment in the market today. Global growth concerns, they're still on the minds of investors, however. Yesterday, we were able to speak to Mark Mobius. He was sounding off on the trade war impact with China as one of the reasons the markets have been a little choppy. Take a listen to this.
The interesting thing is if you talk about China trade war, the trade deficit that the U.S. has with China is growing. It's not shrinking. If you look at the numbers for 2018 versus 2017, it's a larger trade deficit. So I don't see any big changes taking place because of this so-called trade war.
All right, joining us now, Federated Investors Client Portfolio Manager Jordan Stewart, along with Bannockburn Global Forex Chief Market Strategist Mark Chandler. Jordan, let's start with you. Your take on this.
Look, I think the market for some time has been pricing in a slowdown in growth. There's lower rates that are coming our way. In our opinion, that creates opportunity for growth companies. Companies that don't need economic growth, don't need super high rates to work. Secular growth companies that, as the previous guest was talking about before, that are changing the way we live, that can control their own destiny and through technology create their own earnings and revenue growth.
Mark, do you think that the fears about global growth slowing are a little exaggerated when it comes to the impact that we're seeing in the market? I mean, it's not like the world is coming to an end. It's expected that growth will slow a little bit, and even in China, it's a marginal slowdown.
Yeah, so I think a lot of the slowdown is looking in the rearview mirror. I think that we know that something bad happened in Q4 last year when the stock market sold off, but also thinking about spilling over into Q1 this year. It looks like the U.S. economy probably came close to stagnating. We had the government shutdown, the cold weather, all this really froze up activity.
But part of that was the Fed, too. I'm sorry to interrupt you. That was really, a lot of that had to...
Your yield is negative, so I think that lower yields overseas, negative yields. Right now we're looking at something like $10 trillion in negative yields. I think this makes the U.S. 10-year Treasury look more attractive regardless of what you think the economy is doing.
Do you agree with that point of view that the yields around the world sort of are going to create a situation where, obviously it's all interrelated, right? And it's impacting our market, but the inversion of our yield curve, it's causing a lot of alarm.
I think these macro concerns create opportunities we've seen the last 7 or 8 years. The market starts to price in 5 or 6 different recessions during this recovery. There are still companies like the FANG stocks, like the IPO market that's coming, that are changing the dynamics of our economy, and that whether there is a slowdown and then we're going to pick back up, that there's secular growth out there, and this is probably going to create some opportunities.
It's not just the United States relationship with China. It's not just slowing growth there and also ongoing negotiations and trade talks. It's also China's relationship with Europe.
Yeah, so here's what I think is really happening in the big picture, is that I think that there is a new Cold War that's begun between the U.S. and China, and the trade negotiations is only a small part of it. Look what the U.S. did. It recently, for the first time in several years, sent ships through the Straits of Taiwan. We're trying to encourage Europe to not use a particular Chinese hardware provider. So I think that this is a multifaceted development, and like the first Cold War, the second Cold War is battle over Europe. Europe doesn't have the national champions that can compete with the U.S., China, or, last year India became the 5th largest economy. This year it's likely to surpass, 6th largest economy, likely to surpass the UK this year. The world is changing and Europe is not able to compete. So I think that the battleground for this Cold War is Chinese influence into Europe, and that's beginning this week. There's an EU summit later this week with China. China just bought, I think it was $35 billion worth of Airbus planes, and some of the ones that compete with Boeing.
Yeah, no, we talked about that earlier.
China is playing, China wants to take Europe away from the U.S., and the U.S. is doing a good job job of pushing Europe away. President Trump is talking about not just charging our allies to house American troops, but he wants the 50 cost plus 50 is the mantra. So we are doing a lot of things to frustrate our allies at the same moment in time where China is doing their best to pick them apart.
All right, final or two, Jordan, real quick.
Yeah, look, I think there's plenty of opportunities. This similarly reminds.
Family that owns restaurant mega conglomerate JAB Holdings admits to a Nazi past. Apple Metro CEO Zane Tankel joins us with his reaction straight ahead. Welcome back to The Ticker. Moving on to our next story, an unsettling link to a Nazi past. The Ryman family, Apple Metro CEO Zane Tankel. Zane, Apple Metro owns New York Metro Applebee's. Your take is being in the business on this story, you know, in terms of how people are reacting to it today.
Well, I don't know how they're reacting to it, but my reaction would be to ignore it. It's yesterday's news. I mean, there's so much happening every day, each and every day. I learned a long time ago, anything that's really controversial that deals with the consumer, just duck and shut up, and it'll be another story to replace it. You know, I don't think it's fair to talk about something that has happened 100 years ago. Number one, number two, if they were still endorsing that philosophy, then it would be a topic for discussion.
And that's what their defense is in this situation as well.
I think it's a fair defense.
They're saying, you know, it really shouldn't impact our brands or consumers' ability to connect, right?
I would agree with that wholeheartedly.
Let's talk a little bit more about the restaurant business globally, since that's your area of expertise. In terms of what you're seeing with the consumer, with foot traffic, it was that retail sales number that really spooked the markets.
Yeah.
And that, of course, can translate into how consumers are spending on their dining habits as well. Your thoughts?
Well, my thoughts are, it's no secret. We're an economy, we're a country, or a world in transition. And as it transitions, the restaurant industry has to find its way and navigate through it. So obviously more and more consumers are eating at home. This little thing that you have that you push all day long.
Oh, that thing.
Pushing it. We see people come into our restaurants. This is sort of interesting. Family of four. Mm-hmm. They never say hello and they never say goodbye. They sit down at the table.
Yeah, they don't talk to each other either.
Not a word. And I'm not sure if they're texting each other or not, but they sit there and the concept of going out to eat is to communicate. Mm-hmm. It's all about.
It's a social activity.
It's the social activity, right? And it's moving more and more away from that. However, However, there was a very interesting article that I read recently, I just don't remember where, that the human element, the human touch, is getting in more and more demand and less supply. Answer a phone, it's a machine, ask for something, push 1, 2, 3, wait for a voice to come on, et cetera, et cetera. So I do believe firmly that Back to the Future, that certainly those kinds of things that created a reason to go to the restaurants will return. Coming back now, in fairness, a big part of that is also third-party delivery, Uber, Grubhub, and all that sort of stuff.
Speaking of technology, big story today with McDonald's buying that Israeli company that's going to help them integrate technology to know their consumer a little bit better and to streamline the drive-through process. Is there any way that other restaurants, not on the fast food side, are going to start to integrate this? Because, as you said, even though it is supposed to be a social dining experience, people are really lured in by these kinds of, I don't want to call them gimmicks, but to a certain extent, yes.
Yeah, well, we're all trying to parse as much technology and as much data as we can to identify you, the consumer. And as we do that, we're able to really pick you out of the crowd more and more. So sure, that's important. It's also somewhat intrusive to learn. The more you learn about people, but it's the way the world is going. Certainly the way the country's going. Certainly the way our space is going.
Yeah.
And I always say we're going to wind up somewhere between a concierge and a Target store.
Yeah, I'm always amazed when I go to LaGuardia Airport how if you want to get something to drink or eat at one of the kiosks, you don't talk to a person, you put your order on an iPad.
Not a word.
That's how it goes.
But that technology, vis-a-vis the technology we have, you'll be happy to learn, doesn't really deliver any real data. All it is used to deliver your food and get you out of there.
Right.
What we're looking for is technology that can give us data as well. What you ordered, what your preferences, what you liked, what you didn't like, etc. We're doing things like, for example, to make it easier for the consumer to dine in, it's called I've Arrived, and that is you can order from your app, and we don't put it on the fire, we don't cook it, but when you arrive, we track you, and we just track with GPS which table you're sat at, and we immediately start cooking. So your food is delivered in a much quicker fashion while you're there on your iPhone texting each other.
Yeah, you know, Apple revealed and rolled out all these services yesterday, and we've been having this ongoing conversation about companies that are partnering with them, a company like Netflix saying, you know what, we don't want to stream with you, Apple, we're fine streaming on our own. Do you find in your experience that working with Apple it's generally beneficial?
I think that working with anybody is beneficial. As much information, so the space is going to smaller and smaller spaces since there are fewer and fewer people going out. So what we're finding is that what we're looking for, we built an average restaurant that has 5,000 square feet. We have two in New York City here that are over 15,000 square feet. But having said that, we need smaller spaces. We don't need the big boxes. They're not there.
Zane Tangle, great to see you. Thanks for
Thank you
dropping
so much.
by.
Thank you.
Meantime, coming up, the showrunner for HBO's hit show Veep joins the final round in their new season debut. Don't go away. You don't want to miss it.
On stocks popping here as energy and tech shares lead the way.
And I'm Miles Udman. This as yield curve inversion fears recede. For now, a little bit. We'll have more on that story and the markets coming up.
A little bit. Plus, McDonald's goes high tech in a big way, but will customers and investors be loving it? And Wall Street gets bullish on former chip darling NVIDIA. We discussed in the Analyst Rumble. Plus, Veep showrunner Dave Mandel tells us what to expect on the final season of HBO's political comedy. With us now, we've got Yahoo Finance's editor-at-large Brian Sazi and Brian Chung to talk about today's market action. It's an all Brian roundtable.
Brian sandwich.
Sounds winning to me.
Brian sandwich. The Brians are the bread, and Miles and Jen are the meat today. Stocks off highs right now for the session. We're still holding on to gains, though, on the Dow. Disney, 3M, Johnson & Johnson leading the way. S&P, guess what? We got all 11 sectors in the green. NASDAQ also higher here. So some news on the data front, housing data, consumer confidence came out. And you know what? Even though we're green here, those numbers were not great. They disappointed. February construction of single-family homes dropped to a new 2-year low. And this is on the heels of all this data we're getting that the world is slowing down. So are we still the best neighborhood here? The best house in the neighborhood? Do we care about this data?
That's a fine turn of phrase. You can always pretty much break that one out and be, directionally right, I guess. But yeah, I mean, we're going to talk about the consumer confidence number a little bit later in the show. But I think there are some elements of that report, notwithstanding the headline drop, that don't look great for the U.S. economy. Now, the housing market's slowing down, not a huge deal considering the decline we've seen in rates. So 30-year rates spiked at the end of last year as regular rates, as the Treasury curve, got higher across the board. But the drop that we've seen in yields, notably the 10-year, which is what 30-year mortgage rates are based off of, that decline will make conditions for buyers more favorable. But if the labor market doesn't hold up, then it's not going to matter how favorable 30-year rates are.
I don't know. I'll be a little worried about that next jobs report, especially coming off the 20,000 increase we had, the Fed doing its thing. But look, we're off the high. We're off the highs of the session here. That consumer confidence report certainly didn't get me jazzed up. And you still look at the bank stocks. Bank stock action remains weak. Some of the chip sector still looks weak. We had $108 billion come out of the ETF space in the transport ETFs yesterday.
Actually, we had Dr. Schiller, who actually created the home price index on one of our shows earlier today, and he said that we're not in this, and I'm quoting, the sort of mood right now where we weren't so speculative as we were back then, referring to the financial crisis. So it seems like this isn't necessarily something to pound the alarms on, and even though the Fed is data dependent, they're not going to change anything based on one data.
So I agree with Schiller broadly, but I do think that he falls into a trap that we certainly fall into, and you see a lot of analysts fall into, which is like, well, this is nothing like the financial crisis. It's like, yeah, well, the financial crisis was the worst depression we had since the Great Depression. Really, we've had 2 Great Depressions in the U.S. since the Civil War. They happened in 2008 and 1929. And so to compare it to that, you're always going to look like everything is fine. But I do think that it is worth noting that the U.S. economy, on balance, does not look as strong as it did 3 months ago. How much it slows down in the second quarter is certainly something to be wary of.
I mean, the comps are hard when your last comp is as bad as the financial crisis was, right?
Everything looks fine.
Everything is going to look okay. But we are always going back and looking at historic numbers and trends that we can find. And that brings us to the inversion of the yield curve that we've been talking about since last week. And Treasury still in focus. This after yields on the 10-year note and the 3-year bill inverted Friday. That was for the first time since 2007. We talked about it yesterday. I was saying, don't panic. Well, now, apparently, everybody on Wall Street is saying, don't panic.
We have a great chart, though, that explains or shows exactly why everybody did panic, because we have not seen an inversion in the 3-month and the 10-year. That move go negative in 10 years. And Brian, I would ask you, as someone who follows the Fed very closely, it would seem that while that relationship, of course, has everything to do with what they do with rates, right? It is circular. The Fed does get to determine why that move would invert. There are certainly reasons to be wary of what that is telling us about the economy.
Definitely. And it's not only just because they raised rates, right? Think about 2011 when Ben Bernanke literally twisted the yield curve through Operation Twist, deliberately buying longer-term treasuries so that the yield curve would steepen. This brings a skepticism to the record that the yield curve has in terms of predicting recessions.
Yep. Well, for more on today's market action, let's go down to the floor of the New York Stock Exchange, where Scott Gamm is standing by. Scott, we've got CBS, Viacom back in the news once again, reportedly gearing up to resume their merger talks. What's the latest there?
shares also getting a boost, up 4%. It's the third best performing S&P 500 stock today. Now, there's also a question about who would run the combined company if they did indeed merge. Would it be Viacom CEO Bob Bakish or interim CBS CEO Joe Iannello? These are all big questions for investors. Now, a couple of other stocks that we're watching today, of course, the stock rally today has been fizzling out a bit. You know, we were doing so well, and then midday we kind of lost some steam, largely because Boeing shares moved negative. They were in the green earlier this morning, and we know that even a slight move in Boeing stock can trigger big moves across the broader Dow. And then when you look at the S&P 500, we have Carnival shares down about 9.5%. A few hours ago, the stock was down about 8%, so the selling continuing in Carnival shares. It's the worst performing S&P 500 stock right now. That's because the company lowered their 2019 earnings guidance amid rising energy costs, which is very interesting because crude oil today reached its 2019 high, crossing $60 a barrel for the first time in many months, guys.
All right, Scott Gam, live on the floor of the New York Stock Exchange.
McDonald's is looking to push your drive-through experience into the digital age. The fast food giant announced today that it has agreed to buy Dynamic Yield, a tech company that specializes in personalization and decision logic technology. Brian Sozzi, this acquisition valued at more than $300 million, making it McDonald's largest deal in 20 years. What is it going to do for my Big Mac?
Oh, that name just like mind blown. Wow, this company's supposed to be changing the world. Well,
It better, right? It's such a big deal.
Yeah, they will be changing drive-through. This will help McDonald's revolutionize the drive-through experience, and it's technology that other players don't have. Starbucks, I believe, is dabbling in this, but McDonald's will be able to, you drive up to their drive-through, give you suggested items, which is good because McDonald's has seen hundreds and millions of transactions disappear the past 5 years. So if they can't get those people back, try to upsell them.
So I need more specifics because we keep hearing that it's just going to be like you could get a iced tea on a hot day, and then or maybe you would like
everyone
ice
who works at
cream.
McDonald's knows that this is what they need to do.
Yeah, or you
All
would
right.
like coffee. But okay, I mean, there has to be more to it than that, right?
Well, here's one way it could work.
I need more.
Well, if me and Mr. Meat go to McDonald's, we drive up through there.
The Brian sandwich.
Yes,
Remember.
yes, exactly. You know,
About what McDonald's customers may or may not want, given the time of day, given how often this size car comes through the drive-through, all that sort of stuff. And we take for granted that companies like Amazon and Alphabet know everything about their consumers, and it reminds you how far behind McDonald's is in that area.
all of them, not just McDonald's. To your point, Miles, McDonald's only recently started doing delivery. How they're doing it, they partner with Uber Eats.
Right.
So this is one part of a bigger thing at McDonald's where they understand they just necessarily don't get technology. So they're partnering with other companies to make it happen. Nothing wrong with that.
Hopefully you can just do like, I'll just get my regular, and then I'll just pull up and get it. Of course, I don't have a car.
I want my blue Big
You
Mac.
don't have a car, you don't go to McDonald's, but I know what you're saying.
This isn't working.
Good effort.
In other consumer news, Wayfair is opening its first full-service physical retail store. The new store, located in Natick, Massachusetts, will bring Wayfair's large variety of home goods into the brick-and-mortar space. The store is set to open this fall. Okay. Yeah. The whole idea was that Wayfair wasn't in brick and mortar. The whole idea was that they were going to have bigger margins because they didn't have to have an actual store with actual humans in it.
You're going to need some stores, whether it's Amazon, whether it's Wayfair. The time has come where you need, I don't think you need thousands of stores, but you need at least 100 to show off to the consumer who you are, what you're doing. Not every consumer is shopping on Wayfair. You know, and at some point, too, you want to think about Wayfair potentially even selling food.
Right.
So in terms of pivot, though, I mean, like, let's say you're a Raymore and Flanagan, right? You are hoping that people are aware of what you got in the store, so that maybe they will go online.
New Jersey.
Right, northern New Jersey. But how, like, is that an easier pivot for Wayfair to try to go into brick and mortar than it is for a brick and mortar store to go online, specifically with furniture?
No, absolutely. It's a great idea for them. Why? Because they have no store, so they can test and learn. If that one store doesn't work well, they can close it down and open another location. They're not saddled with the legacy leases like all these dying brands like Gap.
It does feel, though, like if you're not, expanding your physical store base right now as a cool online retailer with some sort of brand name, that you're just not in the game. Like, everyone needs to have a physical presence right now.
Yeah, and I think what you're seeing in the wave of the future is by the stronger brands, they're opening up physical shrines, these big hulking 3 or 4 level stores. Look at VF Corp. They had a beautiful tent pole type store open in New York City 2 years ago. It shows off the best of the brands. Are they making money? Probably not, but they could show off what the true power of their brand is. That's why the big and strong retailers like VF Corp win and other retailers lose.
And in the end, everyone is Sears anyway.
And
so,
Amazon.
Right, so you might as well hit it while it's hot. All right, well, coming up, one Wall Street. Welcome back to the final round on Yahoo Finance. It's time now for our Analyst Rumble. Some of the biggest analyst calls from the stock names you know and love. And first up today, Raymond James upgrading Bed Bath & Beyond to strong buy from Market Perform following a report that a group of shareholders plans to replace the entire board at the retailer. Brian Sozzi, right up your alley. I can see you getting hot and bothered over there.
Yeah.
All right. What's going on here? And then how do you feel about Raymond James saying, we think changes will be implemented at Bed Bath? Effectively, that's their
This is
claim.
awful. The stock has exploded today, up 26%. But Bed Bath & Beyond is a stock and a company I've been following for close to 10 years, and they are awful. This activist team, the entire board, not driving any value. They have ruined value. Where's the change?
So you like this note? Yes, you think that this proxy fight and activists in there are going to be very good for the stock, which has happened today.
The note is way late. That's absurd. But what the activist team has put together, these three activist investors, makes a lot of sense. And they have a very, very, very strong chance of completely throwing out the whole entire board at Bed Bath & Beyond.
Will this change anything? Do you expect management to relent to this?
One of the interesting things on Wall Street, a lot of Wall Street analysts that cover Bed Bath & Beyond don't understand why they have not been attacked by an activist investor before. It is absolutely bewildering. It is actually a long-running joke within the retail sector analyst community. It's time now.
From February 2015 through the Christmas bottom, the stock was off 86%.
And amidst all this, they have purchased, I believe, close to $7 billion in stock over the past 5 years. That is money that has gone up in smoke.
Yeah, we're just looking at the 5-year chart there, stock off 75%. So not a great story for Bed Bath &
I'm
Beyond.
all hot, Miles. Come on, man.
All right.
The only thing I like there are the coupons. But
Right. They also don't expire, even though apparently they do. All right, next up, Tesla. Morgan Stanley analyst Adam Jonas maintaining an equal weight rating on Tesla shares, $260 price target. This comes after Jonas confirmed that Tesla is not under a Wells notice, which means it is not legally prevented from issuing stock. So, Brian Chung, it would seem like the day is coming when Tesla will go to market, even though they had sort of convinced some investors that day would not need to come because Elon Musk said it was probably fine.
But at the same time, the fact that you have a sell-side analyst coming out to try to clarify this means that it's still on the minds of a lot of people, right? I mean, you think about
And
the fact
still
that
not
this,
clear.
ever since the SEC went after Tesla, a few months ago, there's been no real clarity in terms of how they've been able to get out of this. And when it seems like there's a bright light at the end of the tunnel, you have Musk tweeting something again. So I think that if you're an investor that's either interested in Tesla or holding Tesla or short selling Tesla, this adds a lot of noise and another layer of complexity in terms of the way that you approach the stock.
I would like to point out that this is a new record for the Analyst Rumble. This is the shortest note that we've ever had.
It's only a few
Shortest
words.
note. Adam Jonas wins there with the news that Tesla
down the
is
big
not
bucks.
under Wells notice. As I do often like to note, though, Don't talk about the balance sheet. Don't talk about having to issue equity.
That's
it's
right.
Just
the Jen Rogers rule of when you'd have to talk about the Wells notice, you've already lost. That's not that rule applies there as well. All right, last but not least, NVIDIA. Piper Jaffray.
They still have problems clearing the inventory in the channel, and they also have a lot of work to do restoring confidence on Wall Street after a lot of promises they made late last year. But I like this upgrade. The stock is trading only about 25 times forward earnings, according to Yahoo Finance data. That is good. The company does, they still remain a leader in the space. This is what you try to do as an analyst. You try to pick a bottom, make a bold call, and this one actually makes sense.
Idea generation.
I think the bottom at least is here for some of the inventory issues that became such a problem for the stock. Brian Sozzi, thanks so much for coming by. I hope that you're going to be able to go out there.
already loosened the tie. Look at
Calm
me off. What are you
down.
guys trying to do to me?
Now we know.
You know what you
It's
should
trigger
do?
point. Bed Bath & Beyond.
There's that Bed Bath over on 18th Street. You can just go in
I can't
there
go there
and
now.
do some shopping.
I can't go there.
Right, go get some,
Can't do it.
sanitizing.
All right, Brian Sozzi, thanks for coming by. Coming up, some say it's the best show on TV right now. Veep showrunner Dave Mandel tells us what to expect on the final season of HBO's political satire. You're not going to want to miss this. It's next. Political comedy Veep returns to HBO for its 7th and final season, March 31st.
Why do I have to tell people why I want to be president? I mean, I don't want to hear about their jobs.
These are toxic. I'm gonna throw them out. Oh, I've been wanting to ask you. Have you seen how Amy is hovering over Dan? I think they're hooking up.
Dan is not dipping his pen in that ink stain. Plus, she's getting kind of fat in the front. Did you see that?
It is literally all I can think about.
Here with us now is showrunner David Mandel. Hello, welcome.
Hi, thank you for calling me.
So how do you do this political comedy in the era of Trump? Is it easier or
Surprisingly,
harder?
no one has ever asked that. No, it's hard. It's really hard. So much of what the show was has changed. When the show premiered, she would screw up and pay a consequence. There's no such thing as consequences anymore. She spoke outrageously behind closed doors, and that was shocking. Now people do it in front of the closed door. There is no closed door. So, you know, the world is such a different place. It's harder. It really is.
So what I love so much about this show, and I'm a huge fan, by the
Oh,
way.
thank you.
So I've talked to people. I used to live in D.C., and I used to have a lot of friends on the Hill, and I asked them, what is it like working on the Hill? Is it closer to Veep or is it closer to House of Cards? And everyone says Veep.
Yeah, I think people move to DC hoping it's like the West Wing, and then it's just Veep, yeah. But these days, Veep kind of seems almost like the West Wing in its own weird way, because real world has gotten so wild. We seem quite sort of, I don't know, honorable in some weird
Did you have
way.
consultants from D.C. kind of help you, advise you on the
We
dynamics?
bring people in all the time, and what we're always trying to do is, you know, we're not Saturday Night Live. We're not doing what he said this week or that joke. We're trying to maybe get a little bit bigger picture and think of stuff. So, for example, a couple of years ago, we were trying to come up with like a wedge issue that would be a little crazy that Jonah Ryan could kind of run on. And we picked ending daylight savings, which at the time seemed like the stupidest thing a politician could say or do. Only I've got a long list of guys, I think including Mayor de Blasio right now, that have signed on to the Jonah Ryan bill. And the last time she lost, it kind of almost killed her, basically. And this sort of seemed like win, lose, or death. This was the last hurrah, if you will. And it kind of let us it felt like the end. Plus, as I said, it had gotten harder. Right. It was also the 7th season, and so you do find yourself going, did we do that? Did we call Jonah that insulting name? Did we call him, Godzilla's whatever? And it's like, yeah, I think we did. Plus, and I will say this, I was very lucky enough, Julie and I both worked on Seinfeld back in the day. And it always stuck with me that Jerry kind of ended it when he did, as opposed to beating it into the ground. And there's something to be said for, going out with people wanting more, I'll simply say.
So the show airs on HBO. HBO is part of a company going through a merger right now. We also have Disney and Disney and 21st Century Fox, and then of course everybody's competing with Netflix. As a content creator, what is it like to work in this environment right now?
It's really interesting, and I really noticed it even just this week in the doing of the press, for the premiere. Where you kind of are going to your press thing, and then all of a sudden somebody's coming in and they're just kind of like, what is this being used for? And it's like, well, because now HBO is a part of AT&T, but they also own DirecTV, and they have a piece of Hulu. Like, we're doing sort of these special on-camera promos for all of those platforms that okay, I mean, it's not a big deal. I hope people watch Veep, but it definitely hits you. I mean, here's what the good is, or at least what I think the good is. I remember once upon a time when there were, I was when I was working on Seinfeld, and then I was trying to kind of do my own thing, and there was basically 4 networks, and that was it. And they were they were different, but ultimately they were looking for the same kind of shows. The wonderful thing about this, at least in a perfect world as a content provider, is you can come up with a really strange idea, and somewhere in the vastness of that empire is a place that show can air, and that show doesn't necessarily need to have a giant audience, but that it can exist in this weird little niche spot. Now, obviously in success, you have a big thing that can be everywhere, but it also can allow, at least in a perfect world, the interesting, weird ideas. At least that's the hope.
Now, as a consumer, so
yes.
What do you make of the current environment?
Oh, I've never heard of that. Where is that? And half the time they go, it's on blank. And I go, what is that? So it's insane and it's hard. Again, I don't have a perfect answer, but like I said, I at least I sort of say yay when it allows cool stuff. That's the hope.
Do you think that
again.
changes the TV culture though, because not everyone's watching MASH, for
Well,
example?
it is a thing, again, not to go back to Seinfeld for a second, but that's when they started to talk about, they always had a water cooler culture. Right. Well, I don't think there's any water coolers, but the notion that we're all watching the same thing on Thursday night, with Veep, we're part of a really fun evening, which will be eventually Game of Thrones, us, and Barry. And I think that's really cool. To me, that's must-see TV, if you will. And I love watching it on Sunday evening. I'll watch them in order. And I talk about that, and sometimes the people at HBO just shake their head and go, nobody's doing it like that. They're all they're watching when they want, and I laugh, but I like it. So yeah, it's changed because there's less of that communal sense, I guess.
You got to cool off after Game of Thrones.
Yes. Well, right? Yeah, exactly.
I'm the only one here who doesn't
Or you
watch
wake back up because the show is boring.
Game of Thrones.
That's just my take.
You really should.
Let you go,
really should. That's what I want to turn this into.
A little stock market question for you.
Uh-oh.
Well, no, just from a business sense.
Sure.
And I also know you're a big collector of movie memorabilia, comic
art, yes.
Have you made better investments in the stock market or better investments with the crazy things that you buy, and then you have to tell us which one has made you the most?
I have to say, and here's the problem. When you have a stock, like whatever, a share of AT&T that owns HBO, you don't frame it and putting it on the wall of your living room. Do you know what I mean? And you don't, if you decide to sell it, you could always buy another one, and you're happy about the money, but you don't miss it. That's the problem a little bit with collectibles. I guess if you were just sort of neutrally purchasing them as an investment. Unfortunately, I'm still buying it all as a collector. So even the stuff that has, like if I said to you, well, I have have a Frank Miller Daredevil cover and I bought it for $1,000 and I could sell it right now for $150,000. You could argue that's an amazing return, except I don't want to sell it. I really like that cover and I really like having it. I'm not selling it. And so, do you know what I'm kind of saying?
Yeah. And everyone, Miles Udland here in New York, and this is the final round on Yahoo Finance stocks. Pairing some gains here in the final hour of the trading session. Energy and tech shares leading the way, yields backing off a bit, but we'll have more on today's market action coming up. Plus, Wall Street getting bullish on former chip darling Nvidia. It's our call of the day. And what does top analyst and longtime Apple watcher Gene Munster think of the goings-on points? The S&P, however, still holding in above that 2,800 level. We had all 11 sectors in the S&P higher earlier in the session. That is still the case. XLK Technology now up 0.1%. XLC Communication Services also just up 0.1%. But Jen still hanging in there with gains. So a little bit of a fade into the end of the day, but seems fairly orderly and also seems like not as bad of a session as we saw on Friday. All things considered, kind of a flat day again.
Yeah, it does feel kind of flat here. Just looking at some of the other sectors here, just looking at semis, which we've been talking about with Nvidia earlier, up just about 0.8%. Biotech and pharma doing quite nicely. And on the Dow here, Disney leading the way higher, up some 2%. And I gotta just say, guys, because we talked so much about it yesterday, Nike, with the Michael Avenatti news coming out, a big story yesterday afternoon as we were heading into the bell. Today, Nike certainly stabilized, and it's actually up 1%, a little over 1%. It's one of the best performers in the Dow.
Avenatti's still swinging too, apparently. He's fired off a large tweet storm earlier today, so I guess he's out on bail and has a lot of thoughts.
I'm kind of surprised he didn't hold that press conference.
Well, he's heading back to LA now, right? And there's going to be maybe
he has to answer for his other alleged crimes.
Yeah, and then maybe there'll be some more on it. But there you go. Just Nike holding on to gains.
It does sort of outline, though, that in this era, right, when you have a Twitter following as large as Avenatti does, and you have Twitter to use the microphone, who needs a press conference? I mean, press conferences are fine and they're fun, and when the president holds them for 90 minutes, you get all kinds of content out of it. But really, he can say what he needs to say to defend himself I guess so, right?
Yeah, I mean, but it does seem
needs
like
cameras?
who needs cameras when you have Twitter? But there's got to be something else to come from him. But I don't think the investment community is worried about it at all.
Right, and
even though he seems to still be saying more to come.
And it still seems, Brian, I didn't realize we were going to talk about Michael Avenatti for 5 minutes. just
neither
to
did
quickly
I.
wrap it up,
Right.
It does seem, though, and I know you're a basketball fan, that in the basketball world, it's still definitely a major story.
Right. I mean, I think he was listing some names. DeAndre Ayton was one. He plays for Arizona. But we've already known that there have been a number of programs that were implicated in, coach-related issues. And I think that, the extent to what this new information is from Avenatti, I'm not really so sure. But it better be good, given what he's had to go through, I guess.
And the tournament returns.
And the tournament, yeah, exactly.
Sure,
Sorry to digress.
It's such a huge saga, and actually Apple is down on the news and Qualcomm is trading higher. But I wanted to mention that Lululemon's expected to announce some earnings tomorrow after the close. That stock is trading lower right now. The stock had seen some gains, 70% in the last 12 months, and it also recently was downgraded to neutral at Wedbush, forecasting some less margin upside going forward. We're also taking a look at Adobe and Microsoft. They announced a deal to combine their sales and marketing software so that clients can target customers on LinkedIn. And by teaming up, they're also essentially going after Salesforce. So Adobe's been up on the news. And of course, as you mentioned, Apple and Qualcomm. So this has to do with that patent infringement case. And a U.S. trade judge recommended an import ban on certain iPhone models made in China. Now, this recommendation comes from a ruling that Apple had infringed on some Qualcomm patents, and the International Trade Commission judge didn't find any violation with the other patents. There were 3 in all. But today's recommendation is just that. It's a recommendation. It still has to be reviewed by the agency, but it certainly has moved the stock. Apple at intraday was up 2.2%. Right now, it's down 1.5%, and Qualcomm is up 2.6%. Guys, back to you.
Inez Ferre, thank you so much.
Well, as if analysts weren't excited enough about Uber, the ride-sharing company has now swallowed up one of its biggest competitors in the Middle East. That's Careem, for a cool $3.1 billion. This acquisition serves as a precursor to the company's expected and highly anticipated IPO filing sometime later this year. It also raises the stakes even higher for the company as it battles Lyft for industry dominance. Here to discuss is Yahoo Finance's Sabeel Marcellus. So Sabeel, let's just start with what Uber is acquiring, why they are buying Careem for what I believe is Uber's largest ever acquisition.
Absolutely. So it's for $3.1 billion. Careem is Uber's biggest competition in the Middle East. Uber is the market leader because more people download the app and they use it more on a monthly basis, but Careem is available in 84 cities, 15 countries, in an area with 400 people. So Uber definitely wants a piece of that action.
So let's talk a little bit about the acquisition, because they are going to be operating Careem, as an independent company,
Yes.
which is an interesting strategy, I think.
Exactly. So although Uber is purchasing Careem, they're going to leave the brand intact. And you can see why this is a smart move for Uber, because Careem has a lot of cultural, local sensibilities that Uber has not, and that has really helped them compete with Uber. As an example, Careem actually doesn't call their drivers drivers because there's a negative stigma attached with the term driving because it's associated with blue collar job. So they actually call their drivers captains. So there are little things like that.
Captain of my
Careem
car.
knows that
Captain
Uber
my
does
captain.
not know.
Yeah, exactly.
Captain. All right,
Where's
so
Robin Williams standing up on a table?
of course, we were all waiting for Uber. Yes, Good Dead Poets
Thank you.
Society.
Thank you, Jen.
reference. Sorry,
Thank you,
I
Jen.
just
Thank
needed
you.
to make
Brian and I
sure
were
that-
just waiting.
You can't just let that hang there.
But that was recognized.
Really gotta hit on that.
I was already asking a question. But we're waiting for Uber to go public.
Exactly.
Lyft scheduled for Friday. There are reports that they're pricing above the range that we were looking at in terms of where they were going to go out the door.
Yeah, up to
What is
$23
this-
billion for
yes.
Lyft.
So what does this do for Uber's IPO? I mean, is this give us a sense that they're getting closer? They want to do more roll-ups before they go? Is there anything we can read into this in terms of them going into the public market?
Yeah, so for Uber, they're trying to reach their target of having 1 billion users worldwide to have a huge IPO, valued at $120 billion. So that's part of why they acquired Careem. And also Uber's involved in a bunch of different other projects. Also with food delivery, they're investing more in that. Also e-scooters and self-driving cars.
Sure, why not? Anything is possible with Uber.
Right.
Maybe they'll get into content soon. Spiel
Maybe.
Marcellus. Yeah, thanks
Never
so much.
say never.
Coming up, investors weren't too pleased with Apple's big spring event yesterday, but what does top analyst and longtime Apple watcher Gene Munster think of Cupertino going Hollywood? We hear from him next.
On Monday, Apple unveiled 4 new services at its Showtime event, and according to our next guest, those services could add more than $20 billion of high-visibility annual revenue to the company's top line within 5 years. Joining us now to discuss is Loop Ventures managing partner Gene Munster. Gene, thanks for joining us. I want to start, before we talk about Apple's event yesterday, just quickly get some of your thoughts on the news we saw within the last couple of hours of Qualcomm winning that patent infringement case on Apple. So the sale of some iPhones may be halted, or was recommended by a judge that they be halted. This has been hanging over Apple and the two companies. They've been in court for years. Is this really something that, as an analyst of Apple, you're thinking about when looking at where this company can go over the next couple of years?
So the answer over the next couple of years is no. We don't think that this is going to have any material impact. And part of the reason is that ultimately Apple is going to start to build these chips, these same antennas, the patents that they currently license from Qualcomm. They're finding workarounds. That's why Apple's been adding so aggressively in their San Diego office, which is adjacent to where Qualcomm's at. So think of it pretty simple. As they've done this in the past, this is a tried and well-traveled play dependent on Qualcomm. And number two is that people won't, it's unlikely that iPhone owners are going to hastily go out and upgrade to a Samsung phone if they're delayed by a few months getting a hold of the phone that they want. So big picture is it's not a concern.
Right. All right. So let's talk a little bit about Apple's event yesterday and the way that they are outlining the future of their services bundle. I mean, what are your top takeaways from what we heard from the company yesterday?
So services undoubtedly are a big part of where Apple's going. They've made 48 announcements over the last 5 years or the last 20 years. And this is the first time they had a service-focused event. And so I think if you look at the opportunity around services, undoubtedly Apple is going to be really trying to grow these 4 segments. Video is the biggest opportunity, and I'm curious what you guys think about the video offering.
Well, we want to know how much it is. I don't even understand it all.
Yeah.
I think that's my main issue, having watched everything. I just wanted them to say, like, this is what it's going to be, and I wanted to go, I'm going to cut the cord. And I still am left as a consumer not knowing what I'm going to do.
Yeah, it's probably going to be $10, maybe $15 a month, similar to pricing on other services. And I think that the most important takeaway here is they're really focusing on more wholesome content. And I think that if you look at this approach, it is unique. It is very on brand with what Apple's doing. And I think that even though they were light on some of the details that you're talking about, which has frustrated some people, it doesn't change the big story here. Services are becoming more important for Apple. They just announced 4 legs to that. And ultimately, those new aspects are different than other products out there. We can talk more about that, what's actually different about them. But I think that they're a slightly different approach to the market, approach to the content offering, approach to what they're doing around the credit offering, I think will yield this kind of $20 billion opportunity. And I want to just quickly put that $20 billion opportunity into perspective, is that would add about 8% to Apple's overall business, which any revenue growth for Apple off that huge $250 billion overall number will be welcome.
Hey, Gene, Brian Chung here. So I'm kind of curious about the difference between the way that Apple is approaching this and the way that Amazon has approached it. With Amazon, you have the Prime membership, and then through the membership, you get all these other services like video or music or whatnot. I mean, we have this announcement from Apple that these are going to be kind of a la carte services.
Sell off. And in fact, the stock is at $160 billion market cap. The more I've thought about it, the more I'm in the camp that really what consumers want to do is unbundle their $160 per month option that most people are subject to. Consumers don't want 120 channels a month for that cost. What they really want is 6 channels, for example, at $15 per month. So kind of think about spending maybe $80 in total, but get the 6 channels you really want. And that leaves some space for multiple players out there. Netflix, Hulu, YouTube, the YouTube Red product. And I think what is most encouraging to me is in that crowded space of video streaming offerings, I think Apple's focus on kind of more quality content, content that really challenges people to be better, I think is going to be distinct in this market.
I'm kind of keying off the word you used, wholesome, there, and some of the talent that we saw come out. And I'm wondering if they need to differentiate themselves. How do they differentiate themselves from Disney Plus? And Disney, which I also think of as a wholesome brand and a brand that kind of needs to toe that line a little bit.
So it was a kind of an unexpected progression yesterday at the event. I was expecting to see trailers, and what we essentially saw was pitches from some of the actors and actresses around these different series. And so we don't have a ton beyond kind of what they talked about. But I think that at the core, and I am a technology person, I'm not a media expert, but at the core, really what makes these products successful is 3 things. First is you need a great story. Second is quality production. And third, distribution. And I think Apple has clearly checked those 3 boxes around the amount that they're spending, similar to what you would see on a typical Game of Thrones episodes. The type of people who are writing and directing these stories are all iconic, and their distribution is well known. Over 1 billion monthly users. But to answer, I didn't answer your question. So what is actually different about this? What's the unique angle? And the kind of the example I would think about is in a crowded kid space around Big Bird is an iconic brand, but this other character who I didn't know, she was a coder. And I think that's a great example of something that's very Apple-like, very on brand, and kind of the future of
Let's take a look.
Confidence now certainly quite elevated, right? This number right in the 170s for the last several months, but you'll notice here on the chart a large drop in March, the largest 1 month drop, in fact, that we've seen since October 2008. Now, why does this matter? Well, present conditions, the present assessment that consumers have of the economy is more or less a read on how people feel about the labor market. If you have a job, you're going to feel good. If you're getting paid more money, you're going to feel good. That's why this chart has pretty much been straight up and to the right for the last few years. If you pull it back even further, if we were to do a 10-year chart of this index, for example, you would see a very sharp recovery beginning in, well, about late 2009, early 2010, just like a number of other economic indicators. And so what it really says to me is that we do need to be careful here watching the labor market. We've talked a little bit about the slight uptick in initial jobless claims. Don't want to make too big a deal about that because claims are still right around 300,000 per week. So it's not a huge change we've seen, but they have ticked up a little bit over the last 6 months. We have seen a lot of other data that suggests the economy is, growing at a slower pace, not the least of which is, kind of GDP assessments, Atlanta Fed, New York Fed, what have you. But we've seen a slight slowing in the pace of growth from services and manufacturing. And, really ultimately, the economy is about the labor market. And so if this chart is showing some kind of cooling, it's just something to note. That's all. Not trying to ring the alarm. Not trying to ring the alarm. Just saying things were good, but they're not as good.
Does it have anything to do with the fact that wages are going up?
Well, that's why the chart was doing well, right? So the question is, why did you have the largest drop in 11 years last month?
And this might be kind of disconnected, but what do you think this means in terms of inflation? I mean, this is something that the Fed's been struggling with, but if consumers are not going out and buying things, I got to ask you a Fed question now.
As you know, the Phillips curve, if it's not completely broken, it's certainly flatter than we thought. And I think the fact that this reading has been so strong, and yet wages are only finally now starting to pick up, and inflation is nowhere to be found, sort of says, to the textbook side, says, well, RIP Phillips curve.
RIP.
There you go. It was good while it lasted. Thank you, Phillips.
And thank you, Brian Chung, for coming on in for this hour. We're heading to the closing bell here. We are going to be back in just a few minutes. Plus, we've also got our call of the day. We're back right after this. Welcome back to the final round on Yahoo Finance. We are less than 1 minute away from the closing bell right now, holding on to some gains here off of session highs. Though, in terms of sectors, everything is also in the green with energy, the XLE up just about 1.3%. That is the leader. And technology up less than 0.2%. XLK, kind of the weakest green arrow that we have here today. Yield curve inversion continues. We're brushing it off, though,
we are.
today.
You can't freak out about it every day, Jen.
Not every day.
Some days you just have to go on with your life.
Only on Fridays can you do that. Here is the closing bell brought to you by Thrivent Mutual Funds. You're looking at live pictures at the New York Stock Exchange and the NASDAQ market site. Where's our gavel? Oh, I'm waiting for him.
Now, let's see if they break it this time.
That we should not panic over the inversion of the U.S. yield curve. They say that the proportion of the yield curve that's inverted right now is not as high as in past recessions, and that the 10-year Treasury note slump can be blamed on issues outside of the U.S. We've also had Fidelity and Morgan Stanley coming out and saying that they're not too worried either. So, I mean, is it just because whatever it signals isn't happening tomorrow? It's happening in 18 months.
Sure, and also, I mean, I feel like it is always worth it when we're discussing the inversion of the yield curve to take a slight step back and say, what are we talking about? And we see it on the chart that we flashed for a second there. What we are discussing is the yield on a 3-month U.S. Treasury bill, which pays you back all your money plus interest in 3 months. That yield is higher than if you loan the government money for 10 years and then get all your money back in 10 years' time. So that inversion has, in the past, traditionally signaled a recession coming to the U.S. And the question would be, why? It's because when investors demand more compensation to lend short-term and are concerned about future growth, those yields would flip. Traditionally, they are the opposite direction, as that chart also makes clear. And I think what Goldman is basically saying, and Fidelity and many others, is that this relationship on its own does not create a recession. It's not recessionary because this relationship exists. It is just something that has happened before recessions.
That has been an indicator in the past.
And so I think we have these things in market discussion, right? And I think market conversations are always fascinating because here's something we weren't talking about. Boom, it happens. Now everyone's talking about it. And so I understand why every research firm feels the need to come out and say it's not necessary. Campbell Harvey, who is the professor at Duke, who we spoke to on Friday, who first found this relationship in his research, I believe it was his thesis while he was at Duke, it said, okay, this is something that happened causally, but it is not something that must happen.
And he wasn't even looking for it.
He just found it.
He found it.
Presented itself.
Just to piggyback on that, even when you look at the 10-year yield, you have to think about what you're looking at it in relation to. So right now, as you pointed out, it's the 3-month, not the 2-year, not the 5-year. And I think that's what originally a couple months ago people were afraid of, that if it is the 2-year we're talking about, then perhaps it would be a bigger reason to be concerned. And then, of course, in addition to all of these investment firms, we hear Yellen coming out, we hear Fed presidents coming out.
We're on today's market action in the stock market. Let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott, stock we haven't talked to you yet about today, which we talk to you about every day, is Boeing. We had Airbus, their main rival, securing a $35 billion deal from China. What's been the reaction to that on the floor? And I guess just in general, how much of the discussion on the floor is still about the Boeing issue with their 737 MAX jets?
Well, this is a big story on many fronts, and it's surprising because the stock has been pretty stable today. It went in the red slightly today, but at the close, it's back to the flat line. And I'll talk more about the resiliency of Boeing stock in a moment. But first, on this specific story, China's President Xi Jinping was in France the other day and signed a $35 billion order between France and China. Basically, China will buy $35 billion worth of Airbus planes from France, which is sort of the home country of Airbus, so to speak. And that order includes multiple A320 planes and A350 planes. Now, with the A320, part of that includes the A320neo, which is the arch rival to the 737 MAX, which is the same plane that has been grounded. Now, you could look at this in a few ways. Does this mean that China doesn't want the 737 MAX because of all of its technical issues? Perhaps. And remember, China was one of the first countries to ground the 737 MAX. They were way ahead of the FAA. But you could also look at this through the lens of trade negotiations. This order basically sends the U.S. a message that, look, we don't have to rely on Boeing. We can get our planes from Airbus. And remember, China's going to need something like 7,000 planes over the next decade to keep up with their growing population. So this is an important story for not just the issues that Boeing is dealing with, but also with trade negotiations. And I think there is a consensus down here on the floor that Boeing will resolve its issues with the 737 MAX. And even with the 4,600 orders of the 737 MAX that are on Boeing's order books, is it practical for all of those orders to go to Airbus? No. So Boeing stock remains pretty resilient. It's trading about $8 above the low for the stock since that tragic crash happened a few weeks ago, guys.
All right, Scott Gamm live on the floor of the New York Stock Exchange.
Let's go to our call of the day. It's NVIDIA. Piper Jaffray initiating coverage of the chipmaker with an overweight.
And now you have the confidence to come out
I
and
have
say,
no idea if this person just started or when
Right.
they stopped
Exactly.
coverage or anything happening
But it's
there.
almost like a reset.
Yeah, it's a nice time. Yeah, it's a nice time to come in here. The stock is down, I think, just about 25% over the last 12 months, and it's up about 30% though since recovering. And the big call here is that this is on gaming. So we used to talk about NVIDIA being all about crypto, and now it's just a big call that the long term is on gaming.
Yeah, I think what's interesting here, though, and the firm notes it in their kind of overview of the company, is that the semiconductor business, the reason investors like it or follow the semiconductor space as an indicator of the economy, is it's extremely cyclical and very prone to very sharp downturns. We had the 5-year chart of NVIDIA up there a second ago, so the stock's up 800% over that time, right? But it was pretty much cut in half in like 3 months at the end of last year. If you were to look at NVIDIA's stock chart since inception, which we have right now, we see a number, oh no, it's 5 years, sorry. We see a number of periods that are like this, right? There was a huge boom in NVIDIA in 2000. Of course, a lot of other stocks had that boom as well. There was another run-up in NVIDIA shares in 2007, 2008. So it has followed the economic cycle. It's followed the semiconductor industry. The stock, as Piper notes, still trading at 33 times 2020 earnings. Not cheap. The firm thinks it can trade at 38 times 2020 earnings. Not cheap.
But not 54 or whatever it was, you know,
sure,
on
but
the high side.
If the economy is in fact slowing down, I mean, I understand the thesis with NVIDIA. It's autonomous vehicles. It's their GPU chips in all kinds of different tech. You know, there's an angle for AI, and everyone comes on our show and tells us about AI and Bitcoin and all this other stuff. But if the economy in the world and the U.S. is going to be slowing down over the next few years, it's going to be hard for a stock and a sector like semis and a stock like NVIDIA to really be outperforming and to be getting a premium that's 3x what the S&P trades at.
Yeah, I think even coming off of that GPU or graphics processing unit, the big tech conference that they held over the last couple of days, analysts overall are feeling pretty bullish given the fact that they're streamlined, they're not looking for new acquisitions. As we know, Jensen Huang, the CEO, announced that he, quote, likes to have money and he's going to save his money for a while after that Mellanox acquisition for about $7 billion.
Like that Mellanox deal.
Yes. So I think given the fact that now it's just core focus, as you mentioned, crypto mining had really taken a hit, but
all about gaming as well.
I mean, do you know how many people are going back to Super Smash Brothers? Like the way that people are spending their time. I mean, I know this is not the necessary definition of cyclical, but we're seeing those kinds of trends come back to light with even 30-somethings who are now saying, "Hey, I'm going to use a controller and do desktop gaming."
Get in
Not all mobile, yeah.
Piper,
millennials ruining everything.
Millennials, darn millennials.
Always.
Piper Jaffray saying an excellent entry point given earnings growth.
There you go. Take a shot. Best of luck. The global ETF industry has amassed more than $5 trillion in assets under management. So what are some of the hottest trends we're seeing in that space right now? Sam Masucci is the CEO of ETF Managers Group, and he joins us now. Sam, thanks for joining us. And let's just start with a high-level take, your view of the current market environment. We've seen recent data with flows out of stocks, actually, in the first few months of this year. Where are you guys seeing investors put money to work, and what does it seem like folks are excited about right now from where you sit?
Thank you for having me. Well, ETF Managers is a thematic investment ETF shop. We have just under $4 billion, and so we're finding still significant growth in thematic investment ideas. Our largest grower and performer for the year has actually been MJ, which is the first medical marijuana ETF. We've taken in almost $700 million this year alone, and it's up about 48.5% for the year. So it's a great opportunity for people to invest in this thematic idea and invest really in this tremendous growing trend of alternative harvest, which is what's going on now within the cannabis space. So we're real excited about that. We're also here celebrating today with the closing bell, Hack, which is $1.6 billion, and iPay, which is a mobile payments fund with $450 million. So very, very unique investment themes that we see continuing to grow.
You know, and I wanted to ask you about Hack. It's a fund that we've talked about from time to time here on the final round. Now it follows the cybersecurity industry. Can you just talk a little bit about some of your top holdings there and how the fund has performed over the last couple of years?
Sure. So the fund is up over 16% for the year. It continues to be a growing theme. We did see about a year and a half ago a significant tail off from assets when people were taking advantage of the growth in assets like CyberArk. But now that we're seeing a resurgence,
ETFs hold any water, and in terms of the orderly entry and exit from some of your funds, I mean, did you have any of those dislocations where your end of day NAV was completely out of whack with what you were actually holding in the underlying fund?
We did not, and a lot of times you hear that from non-ETF people that are pitching their own book a little bit. ETFs are extremely liquid once they get to a minimum asset level. They're very, very easy to get out of through the creation and redemption process. And so we see really virtually no dislocation, at least in our funds, of the actual traded price and closing price of the fund and the net asset value. In fact, just the opposite. We find them to be generally the most efficient way for people to invest in narrow investment themes.
Can you talk to us a little bit about fees? And just, we keep hearing that there are fee wars going on, whether it's with ETFs or with online brokerages or wealth managers. How do you see that? And is that a pressure that you feel?
I mean, there clearly is a fee war going on with some of the largest ETF issuers. It tends to be around funds that are very, very widely held. They're core investments for pensions and insurance companies. ETF Managers is very unique in that we offer access to themes that typically are not available. 75% of our fund launches were first to market. Most are the only one in the space or the largest. So we're not getting that kind of fee compression. We're able to really deliver value to investors by giving them global access to these unique themes like medical marijuana, mobile payments, gaming, and cybersecurity.
All right, Sam Masucci, the CEO of ETF Managers Group. Thanks for joining us.
Thank you for having me.
Democratic Senator Tammy Baldwin is introducing legislation to ban open market buybacks. Yahoo Finance Washington correspondent Jessica Smith is live in D.C. with us. So Jessica, this is really far from the first time that we've heard about legislation limiting buybacks. What exactly would Baldwin's proposal do?
Well, Senator Baldwin plans to introduce this legislation tomorrow. It's called the Reward Work Act, and it does a couple things. As you mentioned, it bans open market stock buybacks, though it would still allow buybacks done through tender offers because Baldwin says they're subject to more disclosure. Her bill would also require public companies to have 1/3 of their board elected by workers. Buybacks have really been in the spotlight, argues buybacks are driving wages down, they're increasing income equality, and it's putting the economy at risk. And the report argues that companies and economies that give workers some control and some say actually do better, and that's why she's pushing to give workers a voice on corporate boards.
Hey, Jess, Melody here. So yeah, to your point, it's Schumer, Sanders, Rubio, the list goes on and on. Are they hearing from their constituents that this is something that they care about? You know, where is this heat and fire coming from? And when you talk to perhaps normal citizens, is this a top issue on their mind?
I think it's coming from the tax cuts, right? It all goes back to the tax cuts from 2017. And Democratic lawmakers are saying, you know, you should be investing your money in your workers. We want wages to go up. That's kind of their argument that we've heard even before that bill was passed. That was kind of their talking point there. So I think that's why you're seeing this come up so much, because it's a way to go back to the tax bill. And Senator Baldwin says that, you know, she is hearing from people who are not in control of or don't have as big of a say in these companies, and that they want more of a say. They want to see their wages go up. So she says she is hearing from her constituents in that regard. Her bill is going to face an uphill battle in a Republican Senate. She introduced the bill last year as well. It didn't move through the Senate. But as you mentioned, Marco Rubio is a Republican senator who wants to address this issue just in a very different way. He wants to change the tax treatment of buybacks to encourage companies to invest in workers in their business instead of repurchasing shares. So we're going to actually talk to Senator Baldwin tomorrow during the first trade. So we'll ask her some of these questions and see where she thinks the two sides can maybe come together on an issue that they all agree, not all of them, but a lot of them agree is a problem, but they disagree on how to fix it. We'll see what she thinks about finding some common ground here.
That would be a once in a lifetime. They all agree.
Well, and here I was.
Consensus.
I thought, we rattle off Sanders, Schumer, and Rubio. I thought the joke was that they're all Democrats. Thank you. Thank you. Here all week. Here all week.
Yahoo Finance Washington correspondent Jessica Smith. Coming up, from Andy Dick to Melissa Joan Hart to even Katie Couric, this app lets fans connect with stars. For a price, we talked to the CEO of Cameo. Right. What if your favorite celebrity sent you a personalized video message for your birthday or gave a video toast at your best friend's wedding? Look no further than Cameo. Joining us to explain the business is co-founder and CEO Steven Galanis. How you doing?
Thanks for having me.
Tell me what Cameo is. I've been on the website. I've seen some of the celebrities.
Yep.
How does this work? They're really going to wish Miles happy birthday?
Cameo is a marketplace where you can go to our website, cameo.com, and search through over 10,000 different people to pick the right birthday person for Miles. You'd go on, you get to write 250 characters. In 7 days or less, you will get your video.
250 characters.
Correct.
So how many words does that usually work out to be? Like,
It's
what
about-
do they usually say?
So, when did you found the company? How long have you guys been around? Because I've heard about you a little bit more in the last few months, but I don't know if there's years of history that I'm missing.
So the company is 2 years old as far as like us actually selling videos. We've been working on it since October of 2016. We had the idea leaving my grandmother's funeral of all places when my co-founder Martin, who is an NFL agent, showed me a video he'd gotten one of his players to make for a buddy who was pretty high up in Nike's marketing department. He got a Seattle Seahawks player to congratulate this guy on having his first kid. And that guy put it on Instagram and said it was the best gift he ever got in his life. That was our aha moment, and we're like, this needs to exist. We just need to figure out how to get people to actually do this at scale.
I mean, it's so interesting looking at the pricing model. So Chris Harrison, the host of Bachelor, is $475.
That makes sense.
And a lot of the reality stars are a lot more expensive. Bethany Frankel, $275. How is this really a metric of who's trending right now? Is this a good indication of celebritydom and what matters in the real world?
We tell the talent to optimize for amount of cameos created versus how much they charge, first and foremost, right? So someone like Tyga or Antonio Brown, who have millions and millions of followers, they could charge themselves $25, but they would get booked so much they wouldn't be able to do them. So we work with them to help price themselves, but sometimes people just have a number or say, I only want to do a few a day, so I'm going to be at this price.
Have you thought about making them longer?
The talent could make the video as long as they want. So we've had cameos up to 14 minutes in length, and they've been as short as 3 seconds.
But like having people pay for more, I guess. Like, have you thought about, let's say, it's not a great association, but this is kind of making me think about what Fire Media was supposed to be, right? I mean, they were supposed to be a platform for booking talent. I mean, if you thought about, all right, well, for 5 minutes of a phone call that we know is going to be 5 minutes long, we'll go a couple $100 with person
The
X.
core idea with Cameo has always been for X amount of money doing Y activity with Z person. We're starting with one Y activity, which is the personalized shout-outs, and as we go to expand our product base, there's other fan experiences that there's demand for. So maybe that is doing what Fire tried to do and having Ja Rule show up at your birthday party.
Sure.
Everybody only has so much time in their day.
Yes.
So is there any risk that you are taking some of the celebrities' time where they would be doing this for free, going to the stage door for free and meeting people, and instead they're sitting in their dressing room?
At the right time.
How much do you think Miles and I should charge?
I have $5, so I think you guys can do better than me.
I love it. I love it. $5.
That's a very lofty estimate. I mean, you raised 12.
Wow, Melody. Come on.
$2.99, I would say. under that $3 threshold, that's a bargain deal.
Just do it for over $1 because we lose money on if it's a $1.
We'll
That's
go
what I was
$5.
going to ask
We're
you.
gonna go
What is
$5.
the profit share? How much do you give these celebrities?
Every single talent's on the same financial split. It's a 75-25 split talent's way. So if you're $100, you're making 75, we're making 25.
I mean, you raised $12.5 million at the end of last year,
Yeah.
and I'm guessing you're planning to raise some more money as we look at the rest of 2019. But when you think about even hyped up apps like HQ Trivia, and we even have our own that we launched recently called Yahoo Play.
Yep.
How do you make sure that this doesn't just become kind of a flash in the pan? It's a trend right now,
Sure.
and then tomorrow, to Jen's point, you kind of want to see a celebrity in real life, and this won't matter as much.
Yeah, well, number one, our company makes money today just like it did the first day we launched. So that's one of the nice things about actually making revenue as a business, and that's why investors have been pretty excited about it. Secondly, our core idea, as I said, is selfies are the new autograph, right? People have been buying memorabilia and buying autographs for hundreds of years. When I made my first pitch deck for Cameo, I had a 1936 Yankees team signed ball and a 2016 Cubs signed ball. They look identical. Fandom is ripe for disruption, and we think we're doing it. It's a very timeless thing. Meeting your favorite person never gets old.
Fun. I just did the math. I think that if Miles and I do this, I'm only going to get $1.60.
Hey, it's $1.60. Neither of us have right now.
I got to split it with them, and then I got to split it with you. Stephen Galanis, the CEO of Cameo, thank you so much for being here.
Thanks for having me, guys.
All right, well, coming up, he's been called the Indiana Jones of art, and his latest discovery, finding a long-lost Picasso. We go sleuthing in the art world after the break.
Just call him an obtainer of rare antiquities. Famed Dutch art detective Arthur Brand is known as the Indiana Jones of the art world, and he has struck again, this time tracking down a stolen Picasso painting missing since 1999. You're looking at it. That's the Indiana Jones, guys. So get this, this painting
Not Harrison Ford.
was nabbed off a Saudi sheik's yacht on the French Riviera. I don't think you're supposed to keep your Picasso on your yacht, but maybe I'm wrong. Worth 25 million euros, just over $28 million. Brand has made a career of tracking down lost artworks, and just last year he returned a 1,600-year-old mosaic to Cyprus.
What's his commission?
It's,
You know,
I
what is
want to
the-
know.
right?
It's got to be big.
Even if it's like, I don't know, 1 million of that.
And who is he working for also? Like, I'm sure
Exactly.
the insurance company, right, paid out this claim. I, again,
Probably.
don't have a boat or a Picasso, but I'm guessing that they're both insured.
Don't look at me like I'm the boat and Picasso. I mean, I saw Oceans 11,
You guys
12,
were
and
about
13.
to charge $5 for your cameos.
And it's prolific.
Correct. And
Got
he didn't
it.
have as extensive of a
Yeah.
portfolio
Didn't live
that
as
could
long.
be lost.
Did you guys study art history and I didn't know about this?
I did go to the Picasso Museum. It was beautiful, whatever.
beautiful.
But it's almost like.
Beautiful, whatever.
But I'm just wondering, I'm questioning the real rare value that we continue to dub.
This is why I like this show and I like these segments, because I had no idea that Melody was about to crap all over Pablo Picasso and basically say, Picasso.
I'm just jealous.
That
Who's
guy.
that? Right, Picasso. Give me a break
I'd
with
let
Picasso.
that one slide.
Yeah.
But you would give him credit for returning the mosaic,
Correct.
maybe?
Yes.
Hum.
Total kudos there.
1,600-year-old mosaic.
Picasso is overrated. There you go. There you have
Michael
it.
put that on
Michael
the website.
Kelly on that.
Learn something new.
Don't come at me on Twitter.
Every day. I
please.
hope they clip this and blast it out. All right, well, coming up, we'll have more on the final round, plus our top takes on the biggest stories of the day. And we're back in 2 minutes. Welcome back to the final round here on Yahoo Finance. Miles Udland in New York. Taking a look at the major averages on this Tuesday. All three indexes in the green. The Dow up 140 points. The NASDAQ and the S&P both up about 0.7%. After kind of a flat day yesterday, this day looked a lot better. Dow up a couple hundred points earlier in the session, but ultimately, sort of middling, I guess we could say, when things all sorted out. I'm joined, as always, by my co-hosts Jen Rogers and Melody Hom here for the final 25 minutes of the program. Would also like to note, we've been looking at bond yields all week. The 10-year yield settling 241 right now, so that is the lowest settlement for the 10-year since December 29th of 2017. 15 months since we've seen the 10-year settling down at these levels, so certainly something to keep an eye on as we watch the shape of the Treasury yield curve. Well, for more on today's market action, let's go to Inez Ferre. She's live at the NASDAQ market site for more. So Inez, walk us through what happened today, some of the leaders, the laggards that we saw during today's trading.
Yeah, Miles, like you said, the NASDAQ ended higher. FANG stocks were mixed, didn't see much advancement. Semis had seen some gains earlier, but then they retreated except for a few. And one of the stocks that advanced the most, though, here at the NASDAQ, Bed Bath & Beyond. This was after a report that three activist investors wanted to replace the entire board of the company and the CEO. So that stock ended 22% higher today. Also, Viacom has been on a 2 2-day win streak now. So it closed up 7% on media reports that the company is back in talks about a possible merger with CBS. And you'll recall that yesterday the stock rose after announcing it had reached a deal to continue carrying some of its channels on DirecTV. And some of the stocks, though, that ended lower today, Kronos Group reported weak earnings earlier today. The Canadian cannabis company closed 1.4% lower. That news also dragged on some of the other cannabis stocks. And also Apple was higher at intraday, up 2%, but then started declining. This was after a U.S. trade judge recommended an import ban on certain iPhones made in China. And this all stems from a ruling that Apple had.
Range was supposed to be between 62 and 68 bucks a share. Now it looks like it's oversubscribed and it's boosting the price higher to about 70 to 80 at the high end. And that brings the company's valuation to about $23 billion. And then shares will start trading on Friday morning. So I am curious to see what ends up happening. It's so interesting because a lot of the noise regarding disgruntled drivers, a lot of these folks who were supposedly gonna make a protest. There was one really interesting anecdote out of San Francisco where a bunch of drivers showed up at the hotel where the roadshow was taking place or supposedly taking place. Turns out there was a change of venue and there was no one there for them to protest. So that really illustrates to me just how much buzz and attention. And now that bankers are involved, it's like, okay, we're full speed ahead. I am curious though, as this roadshow is happening, if they're lifting everywhere. Or if they are.
Yes, they're
You're
lifting.
not going to Uber.
They have to be lifting.
No, not
Definitely lifting.
Or like, do they actually have car services? You know, like, is lifting going to be the way of the
maybe
the way of the road?
Yes. Yeah.
I mean, it's a very highly anticipated IPO, and I think it is the first to really set the stage for the rest of the companies
And
going forward.
even at that market cap, it's just dwarfed by Uber.
Totally.
And so then when you're looking at, and you know Uber's coming, you're looking at both of these, you think, doesn't this one have more to grow? Doesn't this one have more runway?
Right.
And I feel like we've heard that anecdotally, so it seems like it makes sense for it to be oversubscribed here.
I mean, even think about Uber spending $3.1 billion on the Middle East rival. You know, like that is not something that Lyft could even fathom doing right now because they are so domestically focused. But I do think, to your point, you could flip that and say, using that same argument that there's so much room to grow, why not publicly? Why not on the exchanges? As they get more liquidity, people can be a part of that process, whereas Uber seems to have a very mature business. So I'm curious to see globally whether they can be competitive. I do know for sure they are obviously gaining market share here in the US.
Going to be exciting to see everybody that comes after it.
Yep.
How big this window is open. Miles, what about you?
We're going to stick in startup land today and talk a little bit about the We Company. Last night, the Wall Street Journal and many other outlets, I took a look at the deck myself. We releasing its financials for 2018, and it lost $1.93 billion. It also brought in revenue of $1.82 billion. So for every dollar it brought in the door, a dollar. Positive unit economics over multiple business cycles, let alone trying to go from zero to the largest commercial landlord in New York City. And so I think it just shows the struggle that this company has despite their robust cash positions. Melody, I know you follow the company closely. It just seems to me like the unit economics are so poor on every desk they're renting out that how is this business going to sustain itself other than just SoftBank shoveling cash into the fire?
I mean, and to your point, we were sitting here, one of my top takes 2 months ago was CBRE getting into the shared working space business. And if you think about the impact that WeWork has had, it has been significant just in terms of a cultural shift. 32% of the revenue that they get are from enterprise clients. So Sprints, Dells, all these old school behemoths that are like, how do we attract new talent? This is the way to do it. But I think sort of in the way that first mover doesn't necessarily mean that you're going to be the ultimate winner. They have influenced culture, but the question is whether this company alone can be successful.
And another really interesting part of their conversation around enterprise clients, right, is that you list these companies, IBM, who has had real estate in all kinds of places for decades. Guess what? Real estate is a losing part of their corporate portfolio. Real estate is expensive, it depreciates rapidly, it's hard to repurpose. And so these companies are saying, Great.
yeah.
This can be your problem now. And now we're looking at how much of a problem it is.
You want to be in charge of the Xerox machine?
Right.
Oh, we would love that.
Absolutely.
We don't have to have that person there that gets the paper and does
Right.
with
No
the
facilities,
ink.
folks?
Oh,
Sure.
fantastic.
Yeah.
Yeah, but I don't know. How does it go in the long run?
I mean, amazing idea, great company,
Yeah.
beautiful spaces, but the business as it stands right now stinks.
Okay, so my top take is on Wayfair. As we reported earlier, it's
Jen
going
Rogers
to be
trade. I'm adding that to the portfolio.
I don't actually use Wayfair, but I'm a big internet shopper, so I find this story very interesting.
You're just Amazonian.
I've even moved away from Amazonian completely. I don't know what to call myself now, but just Wayfair opening up a real store. And the whole idea was that Wayfair was just going to be online, just like Warby was just going to be online. And now Warby they're doing better in all of their brick and mortar stores. They realize that that is kind of where it's at. And Wayfair, to me, it's just like the start of everybody else, I feel like, is going to have to come. When is the article?
On your wall, and you see exactly what it would look like with furniture, with glasses, with everything in between that is tactile. You can't do that. You know, like I want to see what this chair looks like before actually committing $400 to it. So I think it's a no-brainer that they need a physical presence. And even with glasses, I still have not shopped at Warby Parker because I like going to a place where there's a little more character and it's unique and there's something that's interesting and vibrant about it. And that experience I still value 100%.
But even with paint, and I'll be interested on your deep teas here, I do think that there is something, it's about advertising as well. It's about being seen in the community where people are making decisions about what they want in their home or what they're going to wear. And so having that there, they get to be part of the conversation. And still that conversation can happen just online, but I do think it would be, maybe they'll even have a place. They'll be in the design district, but you'll walk by it and you'll say like, oh,
should I stop by?
Yeah. Oh, and when I'm looking for something, oh yeah, they're kind of big.
And you're a Rent the Runway fan. It's the same thing. We never thought that there would be a physical store, but why do people go in when all of the inventory is online?
And it's packed.
And it is packed.
Absolutely packed. So all the old Sears now, guys, are going to become Wayfairs.
Yep. And this
That's it.
Wayfair's in a mall.
Yeah. I don't know, I like Suburban Paint, great store. Milburn, New Jersey. There you go. So still hanging in there. All right, coming up, he runs one of the world's renowned family offices. So how are they and other ultra wealthy families putting their money to work? We'll speak with the CEO of the Forbes Family Trust after the break. The Forbes Family Trust focuses on the alternative investment space for high net worth families and offices. And joining us now to discuss is James McGrath, the co-CIO at the Forbes Family Trust. James, thanks for joining us.
Thank you very much.
So let's just talk a little bit about what you're seeing in the high net worth space. I mean, we've seen a lot of the larger banks want to be in that space, in the wealth management space. So what's the business been like over the last decade from where you sit?
Well, it's been tremendous for us. I mean, we think that the model that we're able to deliver to clients makes so much sense. After the financial crisis and really during that upheaval, you really saw a lot of conflicts and the risks inherent to the bank, the broker-dealer-based platforms. So as we're structured, as an independent family office, we don't have those conflicts. We don't do proprietary trading. Our clients are really our only focus. And so that alignment, I think, has been great for what we're doing.
Everyone wants to go where the money is. And I think maybe like 10 years ago, family offices, you would hear like, get me into that hedge fund. What's the minimum I want in that hedge fund?
Yes.
Now I feel like it's, how do I get in that private equity raise? How do I get into that venture fund?
Sure.
Are you hearing that? How do you do that for your clients?
That's absolutely the case. I mean, a lot of the marginal interest in alternatives has shifted pretty significantly from hedge funds to private equity over the past 2 or 3 years. Last year, depending on what category of private equity, it was one of the best years ever for capital raising. But it's similar. I mean, what we do is establish relationships and maintain relationships with the leading private equity sponsors. The same way we also do that in hedge funds. I mean, hedge funds are still a big part of what we do. But in private equity in particular, you really have to commit for a long period of time, not just for one fund, but really to have the wherewithal to commit for multiple funds. And we've been fortunate to establish relationships early on that we're able to leverage for our clients to get access.
The younger investors.
Well, that's actually a fascinating question. And so we have seen some of that. We've worked and we continue to work with some families and clients that have gone through liquidity events from IPOs over the past few years. Obviously, there is a big crop of mega IPOs around the corner. But some of these mid-sized IPOs have also been transformative to some folks who had really concentrated ownership. So it really depends. They're all over the place. But I would say that most of the people we deal with are still very much hands-on and want to do things with their lives. So even though they may not be involved in that particular company, they are going to get back into the game at some point soon. So they may take some time to work with us to set up the investment infrastructure, but they're going to want to get back and start doing things again.
So I think a lot of our audience is, smaller retail investors, individual investors, and I'm certainly not a high net worth client. So I guess when you think about your business and how you would just describe it as, different from the way most people are investing, what's kind of like the biggest difference? I mean, is it just that you have folks with a lot of money who are trying to preserve their capital and would like to do interesting things with it? Kind of how do you look at that divide between what you're doing here and what a lot of other folks are doing with their money?
Another great question. I would say the primary focus for us is keeping our clients wealthy. They're already wealthy. They don't need to create wealth through what we're doing. But our job is to help grow that wealth responsibly and help to maximize what goes to the next generation. So there's planning involved, there's structuring involved, and what have you. On the investment side, though, we have the opportunity to invest in a lot of interesting opportunities, and basically globally across multiple asset classes. So equities, fixed income, the non-traditional assets, hedge funds, private equity. And so we're able to deliver all of that while you're basically managing that backdrop of intergenerational wealth transfer. And so that's the difference. We're not looking to knock it out of the park. We're just looking to preserve wealth.
What's one thing that people come to you and they say, I really want to buy this, but is just going to be a huge waste of money?
Well, the rage over the past year or two, or maybe not so much the past few months, cryptocurrencies. We've tended to, there are other ways of participating in that whole value proposition. So we are looking at that.
And has the tax changes made any impact on your doing business?
Well,
like
sure.
What you guys do?
I mean, a little bit. Obviously, most of our clients have bigger fish to fry, but just the ability to deduct state and local taxes, that's meaningful, particularly for people who continue to reside in the high tax state. Things of that nature. But that there have also been some benefits, as well. Obviously, more on the corporate side. So it's a bit of a wash, but we certainly hear from people who are New Yorkers or reside in California or a few other places.
Soon to be Florida residents, I suppose, on the long term. All right, James McGrath, the co-CIO at the Forbes Family Trust. Thanks so much for joining us.
Thank you so much. Appreciate it.
Coming up, autopilot gone wild. A British Airways flight bound for Germany ends up in Scotland. How did that happen? We have that for you after the break. An empty Southwest Airlines Boeing 737 MAX returned to Orlando's main airport on Tuesday after reporting an engine problem. The Federal Aviation Administration has come out and said the Southwest plane, which was, again, not carrying passengers, was bound for Victorville, California, where the carrier is storing aircraft that have been grounded. We are reaching out now to Southwest for comment. Of course, this follows the grounding of the 737 MAX fleet. Thank goodness nobody was on board.
On the plane.
Right?
Right.
So
I think the problem now for Boeing is okay, so mechanical issue with the engine,
Yeah.
kind of standard stuff, but anytime there's a problem with one of these planes now, it's going to become a news story.
It's an alert, yeah. And then we're like, oh, and it's like, this happens every day.
but anytime it becomes a brand issue.
Yeah.
And
Absolutely.
when this first came out, we talked to aviation attorneys and pilots just talking about, do they have to rename these planes when they come out? Eventually, it just seems like people are going to be.
On one.
Miles isn't getting on one. I don't think I'm
you
getting
switch your
on
flights.
it.
I will.
Melody's getting on it.
You know what flies
Sure.
great?
I have an
Regular
appetite for risk.
737s. So, that's me.
We'll update you on that story if there's any more breaking news. But right now, here's Miles with a look ahead of what's going to be making headlines on Wednesday.
Well, it's time to talk about the U.S. labor market. On Tuesday, the Conference Board's latest reading on consumer confidence showed that consumers are less optimistic about their present economic situation. This reading dropped by the most in 1 month since October 2008, from February to March of this year. And this data is pretty much a fancy way of saying, what do consumers think about their job prospects? And the answer this month has not been great. And this comes at a time when investors are worried about recession risks, and some labor market data are starting to look a little bit sketchy. Initial jobless claims, a weekly report on filings for unemployment insurance, are seen as one of the most reliable indicators of labor market strength or weakness. Over the last 6 months, claims have increased about 10%. Now, it's not a huge deal, but it is definitely something worth keeping an eye on. It's ahead. In the last few years, discussion of a potentially softer U.S. labor market has not really entered the conversation at all, so consider this your formal notice of a new wrinkle to track as we enter the second quarter of 2019. Now, turning to the calendar for Wednesday, on the earnings side, Paychex, PVH, and Lennar will be the members of the S&P 500 reporting results, while earnings out of Lululemon will also be a highlight after the market close. And on the economic data side, the January balance of trade is the only major report expected for release.
Lululemon.
Should I wear Lulu tomorrow to celebrate the report?
You were sporting Lulu on Saturday.
Let's all do it.
I'll wear joggers instead of.
I think we're doing pictures on the set, though. So maybe you shouldn't do your
It's actually very much not a good day. Someday
If they do well, then you have to wear it on Thursday.
For the Q2
right?
earnings.
There you
go.
No, I have to. I'll explain after the set.
Okay.
Maybe in June. Maybe
in June. We'll hold out. We'll be waiting. That's all for now from New York. I'm Jen Rogers with Miles Udland. Thank you, Melody Hahn, for being here.
Thank you.
This is the final round on Yahoo Finance.